So first of all, I just want to thank you for joining me in this introduction to technical analysis. I'm glad you're taking the time to learn and educate yourself to become a better trader. And this is one area that is crucial for your success as a trader. Being able to spot trends and price action is a skill that really sets the amateurs apart from the pros. So I'm glad you're here. For today, I'm going to give you a brief introduction into what technical analysis is, and then I'll go over some of the most common trading patterns you'll see when you're actively trading. I'll even give you some of our specific stats on how successful each trading pattern has been for us as we've traded the markets over the past 20 years. And I'm only going to cover a few of the most common trading patterns here because in all honesty, you don't need to learn thousands of patterns to succeed as a trader. Some people get caught up trying to memorize all kinds of patterns and end up confusing themselves and losing money in the process. When it comes to trading, keeping things simple is absolutely crucial. So we're going to stick to the basics here so that you'll be able to learn these patterns and actually put them to work for you right away. So let's get started. So what is technical analysis? Simply put, technical analysis is the study of charts, graphs, and the stock market's history in an attempt to determine its future. Technicians say that a market's price reflects all relevant information, so their analysis looks at the history of a securities trading pattern rather than external drivers such as economic, fundamental, and news events. Price action also tends to repeat itself because investors collectively tend toward pattern behavior. Hence, technicians focus on identifiable trends and conditions. In essence, technical analysis determines trends and tries to take advantage of them. Market trends. Trend trading is used to take advantage of trending markets, whether moving up or down in a trend. There are three types of trends: bullish, upward trending; bearish, downward trending; and consolidation periods, where stocks generally trade sideways in a range. How do we identify trends? A bullish trend is characterized by having higher highs and higher lows. A bearish trend has lower highs and lower lows. In a consolidation pattern, they're not making any new significant highs or lows, and things are normally trading inside a band or inside a range. We then use technical analysis to time our entry to the markets and set targets. So here's an example of a bullish trend. You can see from the shape of the graph, it's pretty easy to see. And here's an example of a bearish trend, as everything is trending down. Trend changes. Using additional indicators also helps with identifying trend changes. Trend changes occur once a preceding trend stops making higher highs and higher lows, or vice versa. But it's important to wait for confirmation. Wait until new highs and lows are finished. Using additional indicators also helps with identifying trend changes. Chart types. There are different chart types used for analysis, with the main three being line charts, candle charts, and bar charts. Line charts work on the closing prices of the instrument, the stock, currency, or index. Candle charts give us a bigger understanding of market moves, as they give us more information, namely the open, closing, high and low that the instrument has reached for that time period. It fills the open and closing prices with a body and displays the highs and lows as wicks. Bar charts are drawn with the same information as candlestick charts, but don't have a body. Line charts are formed by connecting the closing price of each period. Here we've got some examples of candlestick charts. Green candles are bullish and red candles are bearish. By looking at the candlestick charts, you can get a lot of information. Here you see where the body starts. This is where it opened, and this is where it closed. Now the wicks show you the price action for the day. So you can see the low of the day drop down here and the high here. And here are some bar charts. The open is always on the left and the close is always on the right. So you can see it's a little bit more simple. It doesn't have the body on it. Trend lines. Trend lines are another very useful tool to help us determine trend changes. Trend lines need to be drawn in the correct way by collecting lows with lows or highs with highs. To identify trend changes with trend lines, we would connect the lows in bullish trends and the highs in bearish trends. Once the price breaks through the trend line, we then have a possible trend change. But what do we need to wait for? Confirmation. We would again use other indicators to help us determine if it is a valid trend change. Either an indicator changing in trend direction as well, or if a support or resistance level has been taken out. The reason for this is that there are often times that there's a false breakout, and we try and stay out of the traps that the market sets up for us. So here you can see an example of a fake breakout. But how would we know? You've got to draw in your support and resistance lines by connecting the highs with the highs and the lows with the lows. So here you can see the two lines that we've drawn in to illustrate this. Support and resistance lines. The more time a line gets tested, the more relevance it has. That's why a fourth test break has more significance than a second test break. Support and resistance lines offer us an invisible level to which the price tends to move towards. It thus also helps to determine not only a possible turning point on a chart, but also a target level. So you can see how this establishes the trend once you draw your trend line in. Why did the price give a fake break on the fourth test? And why would I not have climbed into the trade for a short on the breakout at 4? Reason 1, it hit a support and resistance line. Reason number 2, it never broke the support or resistance line or made a new lower low. So you can see, once you start drawing these lines in, it really helps to make things clear. You get a better understanding of what the trend really is. And sometimes to do this properly, you've got to expand the time frame that you're looking at. Sometimes you've just got to take a step back, zoom out, look at things over a larger time frame, and it helps give you a better idea of what the overall trend is. This all works great in hindsight, but how do we use it to determine what happens in the future? Lesson 1. There are no guarantees in the markets. All we can do is find levels and determine what could happen. By having an understanding of what could happen, we can better prepare ourselves for when it does happen. Lesson 2, we always wait for confirmation. We can only take action upon confirmation. So here again, we've drawn in some of our lines to illustrate what's going on. Can you see how drawing in these lines really helps you to establish the trend and what could happen in the future? Okay, so now I'm going to get into some of the most common trading patterns and formations. We're going to look at 6 of the most common chart patterns and formations that you're going to run into whenever you're trading. We're going to look at the head and shoulders formation, double tops and bottoms, triple tops and bottoms, wedges, triangles, and flags. And if that sounds confusing, don't worry. We're going to go over some examples so you'll be able to understand all of it. So the first we're going to look at is the head and shoulders formation. A head and shoulders pattern is a chart formation that shows up as a baseline with 3 peaks, where the outside 2 are close in height and the middle is the highest. In technical analysis, a head and shoulders pattern describes a specific chart formation that predicts a bullish to bearish trend reversal. The head and shoulders pattern is believed to be one of the most reliable trend reversal patterns. It is one of several top patterns that often signal that an upward trend is nearing its end. And remember, I promised you that I was going to give you the exact percentage that we've run into whenever we've traded this pattern over the past 20 years. So in crunching the numbers, for us, we found that the Head and Shoulders pattern has an 83.21% success rate when we've traded it. So here you can see its formation once we've drawn in our trend lines, and we can see the support and resistance. So this is an example of how it might show up based on your chart and your time frame that you're working with. The next up are the double tops and bottoms. Double top and bottom patterns are chart patterns that occur when the underlying investment moves in a pattern similar to the letter W in the case of a double bottom, or M in the case of a double top. So here you can see that signature M formation here. And for us, when we've traded this pattern, we've found that it's worked out about 76.08% of the time. So here you can see a couple more examples of how you could draw this out when you're looking at a chart. Triple tops and bottoms. Triple tops and bottoms are a continuation of the double top and bottom pattern. In this case, a triple top is formed by 3 peaks moving into the same area with pullbacks in between, while a triple bottom consists of 3 troughs with rallies in the middle. So here you can see that it comes up 1, 2, 3, and then comes back down to reverse the trend. And for triple tops and bottoms, we found out that for us, they've worked out about 78.66% of the time. The next up are wedges, and these consist of both rising and falling wedges. Now, a wedge is a price pattern marked by converging trend lines on a price chart, and they're considered useful indicators of a possible trend change. So in the case of a falling wedge, you see the stock has made a series of lower highs and lower lows inside the wedge pattern before the trend reverses, and it shoots up past the previously established resistance line, effectively reversing the trend. So here you can see it's trending up, comes back down, up, in between this range, and then continues the upward pattern. And here with the rising wedge, you have a series of higher highs and higher lows being made before the pattern reverses and it drops down through the support level that was previously established. Now for us, we found that wedges have only worked 55.29% of the time. So again, this brings us back to just how important it is that you've got to find confirmation of the trend before you pull the trigger on a trade. Now, rising and falling wedges are normally a longer-term pattern. They consist of converging support and resistance lines trending in the opposite direction of a rally. In other words, the consolidation period will be a small trending period with either higher highs and higher lows or vice versa. Triangles. Triangles are generally seen as a continuation pattern on a chart that forms with a triangle-like shape. So here we've got the symmetrical triangle, the ascending triangle, and the descending triangle. You can see how all of them feature that triangular shape. And for us, we found that triangles have worked about 73.11% of the time. So for us, they've worked better than wedges, but not quite as good as some of the other ones like the Head and Shoulders formation. Triangles are generally a shorter term setup, and triangles are usually continuation patterns, but they can also break out in other ways to change the trend. Ascending triangles are normally bullish, and descending triangles are normally bearish. And here we've got flags. Flag patterns generally signify trend reversals or breakouts after a period of consolidation. They're shown with the flagpole to the left of the trading pattern before they trade within a range. So this would be considered the flagpole. You can see how it's trading within this range here, pretty tight. And for us, we found that it's only worked 67.73% of the time. So they've been better to us than wedges, but they haven't been nearly as good as some of the other patterns. So flags normally run in a rectangle between parallel running support and resistance lines. And they're also usually a trend continuation pattern. So that brings us to the end of this brief overview of technical analysis and some of the best trading patterns that we've found. And the thing I want to really leave you with is that technical analysis helps us stack the odds in our favor. Trading is a game based on percentages, and our odds of success are based on the historical outcome. So we can't win every single time, but we can avoid being wrong most of the time. So when it comes to learning to trade, why not play the game in such a way that the odds are stacked in your favor? So I want to thank you for taking the time to invest in yourself as a trader. Just by being someone who's willing to invest in their trading education, you've already joined a select few who will be able to increase their skill level and success as a trader. And along those lines, if you're ready to take your trading game to the next level, I've got a special gift for you. It's discounted access to the exclusive trade alerts we give our members inside the Empirical Collective. We've been fortunate to have enjoyed a tremendous amount of success. And although past performance doesn't guarantee future returns, our members have been making bank with our hedge fund beating trades and quadruple-digit returns. So if you'd like to earn while you continue to learn, I advise you to click the link below for more details and to take advantage of this discounted offer. Once again, I'm Brett Davison, your Minister of Capitalism, wishing you all the trading success you can handle.